Hey guys, scalping is a trading style that focuses on quick, short-term returns. It's great for traders who don't have much time to stay on the charts and prefer fast results. In this video, I'm going to show you 3 of the best SMC and price action scalping strategies that you can apply to get quick results. If you're interested in learning advanced trading concepts, strategies, entry reasons, and staying disciplined with your trading plan, don't forget to hit the like button and subscribe to our channel. Before we start, it's worth mentioning that scalping strategies involve executing short-term trades on lower timeframes during periods of high market liquidity. Scalpers face more false signals because they are dealing with lower timeframes. Therefore, they must manage risk carefully. It's also best to trade major pairs that have lower spreads, especially since spreads matter when targeting 10-20 pips. However, trades usually finish within an hour, making scalping ideal for those who want quick results without spending long hours on the charts. So here's a checklist that every scalper should follow before analyzing the chart and placing trades. Now, let's start with the first scalping strategy. In this setup, we use 2 time frames, the 30-minute and the 5-minute charts. On the higher time frame, we check the market structure to see where the market is going. We look for breaks of structure and changes in character to understand the trend. Then we mark the fair value gaps, which show the best areas to look for trades. We wait for the price to return to the gap areas, and after that, we move to the lower time frame. In the 5-minute chart, we look for a trade entry signal, usually when a liquidity grab pattern forms. Once we see that setup, we enter the trade and set our targets. This strategy works because it combines 3 important ideas. It helps us trade with the trend, take entries from strong supply and demand zones, and use lower time frame setups for extra confirmation. Now let me show you how it works on the price chart. In the first step, we identify the market direction by marking breakouts and changes in character. Although this can be done manually, for the purpose of this video, we're going to use the Price Action Toolkit indicator to do it automatically for us. If you're interested in getting this indicator, check out the link in the description. It comes with a 30-day money-back guarantee, just in case you decide it wasn't for you. After applying the Price Action Toolkit, go to the Settings tab and enable BOS Chalk in the Market Structure section. These are the main elements of the Market Structure framework. Here's a basic diagram showing how the indicator labels market structure. BOS signals a trend continuation, while Chalk indicates possible reversals. Here in this example, we can see that the price is breaking structures to the upside on the 30-minute chart. So we are in an uptrend and only looking for buying opportunities. Next, we have fair value gaps. If you enable this option in the indicator settings, they will automatically appear on the chart. Fair value gaps represent imbalances on the price chart where there's a gap between the fair value of the price. The market often returns to fill these gaps as price seeks balance. We'll use these gaps as key areas of interest, expecting possible price reactions. First, we wait for the price to return inside the gap, and then we look for confirmation signals on the lower time frames to enter a buy trade. So let's switch to the 5-minute chart. Here, in the final step on the lower time frame, you want to look for signs of a possible reversal. One strong signal is the formation of a bullish liquidity grab pattern. When you enable the liquidity grab option in the indicator settings, you'll notice red and green circles appearing on the chart. These represent bearish and bullish liquidity grabs, respectively. When the price wicks above a previous swing high, the indicator marks it as a bearish liquidity grab, signaling a potential downward move. Similarly, when the price wicks below a previous swing low, it's identified as a bullish liquidity grab, indicating a possible upward move. Liquidity grabs highlight areas where the market sweeps stop losses before reversing direction. These signals can be powerful for trade entries, especially when they occur inside a higher time frame fair value gap. If this move also breaks a recent bearish structure on the lower time frame, it provides additional confirmation. In other words, it forms a change of character. Now it's time to open the trade. You can place your stop loss below the low of the liquidity grab, and your target can be the next important level on the higher time frame. Similarly, in a bearish setup, start on the higher time frame by confirming a downtrend with lower lows and lower highs. Then, mark the fair value gaps as potential supply zones. When the price pulls back into one of those gaps, switch to the lower time frame and look for a bearish liquidity grab above a recent high. Enter the trade after confirmation, place your stop loss above the liquidity grab, and aim for the next key level below. With all that said, make sure to use proper risk management to protect your capital. Stick to your plan and avoid emotional decisions. This strategy works best in trending markets, not in choppy conditions. Keep learning and reviewing your trades to improve over time. Let's continue with the second scalping strategy. This strategy is made up of three main parts: a draw on liquidity, a liquidity grab, and the entry. So, what is a draw on liquidity? It basically means identifying a key liquidity level that price is moving toward. In simple terms, the market often moves to areas with resting liquidity, such as equal highs, equal lows, or sharp reversal points, because that's where many orders are waiting to be filled. You can mark these levels manually, or simply enable them in the indicator settings by turning on equal highs and lows, and buy-side and sell-side liquidity. With that said, the first step is to look for a key high or low on the 30-minute chart that the price is moving toward. As you can see in this example, we have buy-side liquidity on the 30-minute chart, and the price is drawing up toward it. We can anticipate the price reaching this high, since that's where liquidity exists. If you can't find a clear draw on liquidity on the 30-minute chart, you can zoom into the 15-minute chart. The next step is identifying a liquidity grab in the opposite direction of our draw on liquidity, this time on the 5-minute chart. So, let's switch to the lower time frame. Keep in mind that the buy-side liquidity is above us. Now, we're looking for a swing low to be taken out, which signals potential upward continuation. You can enter the trade right after the price returns inside the range. Alternatively, a more conservative approach is to wait for the price to continue pushing upward to confirm the reversal, and then look for fair value gap formations to set a buy limit. If you can't find any FVGs on the 5-minute chart, you can zoom into the 1-minute chart for more precision. So let's have a quick recap of the bearish setup. In a bearish setup, first find an important liquidity area that the price is moving toward. This could be a previous low or a level where many stop losses are sitting. These areas often attract the price before it reverses. After that, switch to the 5-minute chart. Wait for the price to move above a recent swing high and then quickly come back down. This shows that the market has grabbed the liquidity and may start moving lower. Next, open a short trade and place your stop loss above the high of the liquidity grab. Give the price some space to move, and don't keep your stop loss too tight. For your target, aim for the next key sell-side liquidity. This way you trade with a clear plan. Now let's continue with the final scalping strategy, which is fully based on price action. This strategy uses one time frame, and it can be any you choose. In the first step, we identify the market direction and decide whether to buy or sell. Trading in the same direction as the main trend increases our confidence and success rate. What we want to see is a clear trending market. In an uptrend, the price should make higher highs and higher lows while respecting the swing lows. In a downtrend, the price should make lower lows and lower highs while respecting the swing highs. In the case of an uptrend, we wait for the price to form equal highs, then break above them. From basic price action, we know that when the price comes back to this breakout zone, supply turns into demand, meaning the price has a higher chance to bounce back up. So we wait for a pullback to this area, and then look for confirmation before entering a trade. We can enter the trade when a candle closes above the previous candle's high. That's our confirmation that the level is being respected. But if we don't see confirmation, and the price keeps dropping, we simply skip the trade. You can also zoom into a lower time frame to find a better entry. After the price pulls back to your demand zone, switch to a lower time frame. Here you'll often see a short-term bearish correction, which is part of the pullback on the higher time frame. Draw a trend line across the wicks where you get the most touches, and wait for the price to break above that line. Once it does, you can open a long position. Place your stop loss below the swing low, and set your first target at the swing high. This gives a clear signal that the short-term downtrend is over, and the price is ready to continue upward with the main bullish trend. Now let's look at the bearish version of this setup. In this case, the higher time frame shows a downtrend, where price keeps forming lower lows and lower highs. All we need is an equal low, followed by a breakout to the downside. When the price pulls back to this breakout area, the previous demand zone turns into supply, meaning there's a higher chance for the price to reject this level. To confirm the entry, wait for a candle to close below the previous candle's low. That's our signal that the sellers are still in control and we can enter a short position. If the price doesn't confirm and keeps moving up, then there's simply no trade. For a more precise entry, zoom into the 5-minute chart. You should see a small bullish correction, a short-term uptrend against the main downtrend. Draw a trend line across the lows of this move and wait for a break below it. Once it breaks, you can enter a short position. Place your stop loss above the recent swing high and set your first target at the previous swing low. This setup shows that the short-term pullback has ended and the price is ready to continue downward with the overall bearish trend. Keep in mind that you can always check the higher time frame to see where the price is positioned in the bigger picture and whether your analysis aligns with it. For example, if there's a key market structure level right in front of the price, there's a higher chance that the setup will fail. That's because when the price reaches this level, it's likely to get rejected by the market. So, always check the higher time frame to make sure there's enough room for the price to move in your direction before hitting the next important level. So guys, that's it for this video. I hope you found it valuable. If you did, please smash the like button to support our channel and help us create more videos like this. See you in the next episode.